What's going on, everybody? What's going on? What's going on? What's going on? Back at it again. Again, the market is back open. We've gotten some relief. The inflation data that we received last week gave us some relief. So that was very, very good. But again, we're back at it again, going over the market, looking at things that are going to help us continue to build wealth over time. And so I really don't want to belabor the time anymore. So again, welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade for yourself. Make sure that you like this, okay? Please like this. Please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. I may drop an episode on a Friday. I may drop an episode on a Sunday. It may not just be on Wednesdays, okay? So I need you to be tapped in and plugged in, getting those notifications directly to your phone so you can be ready every single time I come on here to give some information that you need. For this episode, it's all about technical analysis 101, and this is the only technical analysis class that you will ever need, okay? People try to make technical analysis so complicated, right? They try to make it so complicated and so far-fetched. Look, we're going to go through a presentation to look at the basics of technical analysis and some key indicators that you are going to need to take away. In addition to that, we're going to set up a fresh chart from scratch on Thinkorswim, my new favorite platform, and show you all how to trade and how to look at technical analysis so you can continue to be successful, okay? Now, let me get ready to share my screen here so we can go ahead and get started. And so this is technical analysis 101, the fundamentals of the technicals, okay? So again, we're going to go through technical analysis. We're going to go through all the fundamentals of it. And at the end of the presentation, we're going to open up a chart and actually go through all of the indicators and the things that you need to know for technical analysis. Now, first thing is support and resistance, right? Very simple. Support is a level at which a stock has not broken below, and resistance is a level at which a stock has not broken above, okay? The more a support or resistance line gets hit, the more significant it becomes. And so when you see multiple touches on a resistance line, it's only a matter of time before the stock breaks above that resistance line, okay? Same thing for support. The more that a stock hits that support level is only a matter of time before it breaks below. And so it takes time for us to see if these support and these resistance levels can actually hold, right? We look at them, we look at them on certain time frames. We look at them on daily time frames, on maybe the 4 hour or the 1 hour, maybe even the 15-minute time frame, depending on what type of trader that we are, right? But support and resistance is the key, right? It's the fundamental of trading, being able to establish when a stock is at support and when a stock is at resistance. Now, a trend line is a line that defines the most dominant trend, and stocks tend to respect trend lines, and trend lines can serve as support and resistance. So a stock may stay above stocks may stay above a support. The stocks may stay above a trend line. And if a stock stays above a trend line and comes down and continues to touch that trend line, a stock is continuing to respect that trend line. Sometimes stocks will stay below a trend line, which means that we're in a defined downtrend, right? As we will see whenever we go over everything later on. Now, these right here are some charts that I want you to look at. These are examples of support and resistance. On the left, notice how the $39 level acts as resistance on Amazon.com's chart between March and November 2006. We've got multiple touches, okay, multiple touches of that $39 level but I believe it's only a matter of time before that stock breaks above that $39 level, right? 51.25 on the right, that's that price for support. We've got multiple touches on that support level. The stock doesn't want to break below that level. And so we have to keep in mind support and resistance level combined with the most dominant trend for the stock. Simply put, buy at support, sell at resistance, okay? Especially when you're bullish, right? You buy at support, sell at resistance. That's what we do, okay? That's just what I want you to kind of get ingrained into your mind, right? Now, candlesticks, right? Candlesticks, very, very important to understand these candlesticks. And now candlesticks make up bodies and they make up wicks, okay? So if you look here at the right, looking at these candlesticks, I'm just going to break it down very, very simple. You have a bullish candle and you have a bearish candle. Bullish candles are green, bearish candles are red. Now, when you look at the body of a candle, let's look at the green candle first. A green candle shows the open price at the bottom of the body and the close price is at the top of the body, okay, when we're talking about green candles. You got these upper shadows and lower shadows that they're talking about, okay? These represent the wicks, okay? We call these wicks, and these wicks represent price that came outside of the body, right? Price that occurred outside of the body within the time frame that that candle represents. Sometimes candles can represent an hour. Sometimes they can represent a month. Sometimes they can represent a day. Sometimes they can represent 5 minutes. Okay. That's what we're talking about when we're talking about candles, right? Bullish candles always open at the bottom and close at the top, right? On the bearish side, let's look at the bearish side. For these candles, okay, the red candles, the bearish candles open at the top of the body and they close at the bottom of the body with wicks in between that time frame that the candle represents. And if you look at it, that makes sense. If you're green, if the market is green, that means the stock is going up. So it makes sense that a candle would be filling up from the bottom to the top. Same thing on the other side. If we're bearish and the market is coming down, it makes sense that candles are starting up at the top and then closing down at the bottom. Candlesticks are very important because they signify where the market opens and where the market closes. Okay, we care about, most importantly, where the market opens and where the market closes. That can provide conviction and confirmation for where we believe the market will continue to go. Now, you can use candlesticks and chart patterns to help you enter and exit trades. And so right here are some key chart patterns you should be able to easily identify, okay? And I'm not saying that you have to know all of these chart patterns from the beginning, but these are the ones that you should be able to identify over time as you continue to look at your charts and continue to trade. Some of my favorites are bull flags and bear flags, as we can see here. Bull flags, bear flags. Symmetrical triangles are very, very good. Another one that I like is a double bottom. A double bottom is a reversal pattern. Also on the other side, a double top, which is a bearish pattern, right? And so when we look at these, right, be able to identify these patterns, okay? Stocks move off of trends, right? Stocks move off of trends. What is the most dominant trend? Trends and patterns, right? Being able to identify trends and patterns when you are trading in the stock market is going to help you out a lot. Now, some key technical indicators that I want you to have in the back of your mind that I want you to utilize and pretty much have in your toolbox, right? Disclaimer, all of these indicators are not the end all be all in terms of getting in and out of trades. These are just tools that are in your toolbox that you just want to have in your back pocket to be able to bring them out and utilize them whenever you need them, right? Certain strategies may not bode well for certain indicators. And so that's what you need to pay attention to. Now, number one, RSI, Relative Strength Index, which measures overbought and oversold conditions for a stock. A reading of 70 means that a stock is overbought, and a reading of 30 means a stock is oversold. Keep in mind this: if a reading gets above 80 or below 20, look for an immediate reversal of the trend. Okay, so most of the time, industry standard is 70 for overbought and 30 for oversold. That's industry standard when we're talking about RSI. If you have an 80 reading or a 20 reading, I believe that's an opportunity for you to exploit what's going on in the market to the upside or the downside. Now, another key thing, the RSI is best used on a daily time frame or higher. Okay, so specifically when you are swing trading, when you are swing trading, the RSI on a daily time frame is going to be what I believe you should use. Okay. Another thing I want you to keep in mind too is that the higher the time frame, the more dominant. So like I said, the RSI is best used on the daily time frame or higher. But let's say that we were oversold on a weekly time frame, or let's say something even happened to where we're oversold or overbought on a monthly time frame. Remember, daily time frames represents the trading that occurs within a day. Like every single day is represented. Weekly time frames represents all of the trading that was going on in a week. So imagine if the market was so oversold that we got a less than a 30 reading in a weekly time span. That tells you how oversold we have been in the market during that time. You'll see these things happen during deep bear markets, late 2018, COVID-19. We probably had some RSI readings that were probably close to 30 in this year 2022. It just depends on what's going on during that specific time. I imagine 2008. I imagine the dot-com bubble in the early 2000s. Those are the areas that we're talking about when we see that RSI below that 30 level on a weekly time frame. Okay, next, moving averages measures the average price over a specified time frame. Example, 50-day SMA or 20-day SMA. And that just stands for simple moving averages, right? The reason why I like to use the SMA is because I like to keep it simple, right? I like to keep it simple, and I especially like to use the SMA when I'm trying to establish long-term trends, right? Other people may like to use EMAs, which stands for exponential moving averages, which means that you're trying to evaluate shorter term trends. And you may use a technical term like the MACD. I'm not going to go into the MACD tonight, but you might want to think about the MACD in terms of thinking about those exponential moving averages. Now, moving averages can be used as pivotal points to determine if a stock can respect said moving average, right? It makes sense to understand that. And when you think about the moving averages, like for example, the 50-day moving average, that's literally telling you what the average price has been over the last 50 days. Same thing for the 200-day, right? What has the average price been over the last 200 days? We've got 50-week moving averages and 200-week moving averages. Those are things that you want to look at. Now, think about this, right? These are two very important things I want you to think about, and I want you to realize. Two terms, a golden cross and a death cross. Okay, so in technical terms, we think about it like this. The 50-day moving average crosses above the 200-day moving average. That is a golden cross. That is considered bullish movement. Okay, when the 50-day moving average crosses above the 200-day moving average. The death cross is when the 50-day moving average crosses below the 200-day moving average. That is a bearish term, and that means that a stock is headed to go into a downtrend. Now, again, like I said before, all of these key technical indicators are not the end all be all. By me saying that, I say that because, just full disclosure, the 200-day moving average and 50-day moving average, these are lagging indicators, right? They move based on price from the previous day. But I believe that they can still help us, and they can still be an indicator that we can utilize Just understand that these are lagging indicators. So they may not be able to help you anticipate something, is what I'm trying to say. It's data that you've already seen that you may be able to make a conclusion based on what's going to be happening in the future. Okay, and we're gonna look at a death cross, because we had a death cross on ticker symbol SPY that we're going to look at here in a minute. Just bear with me here for a second. Fibonacci retracements. Now, if you are really tapped in, if you are a true follower, if you are a true enthusiast, right? If you really truly want to trade for yourself, you understand that on the Trade for Yourself podcast, I've talked a lot about Fibonacci retracements. And I've talked about them from a certain perspective. And so Fibonacci retracements is a tool that clearly identifies levels of potential support and resistance. Okay. In addition to that, Fibonacci retracement levels connect any 2 points that a trader views as relevant, typically a high point and a low point. With that being said, I like to use Fibonacci retracement levels over a long-term perspective, right? And I typically use, for now, like right now in this current market, I typically use Fibonacci retracement levels to measure the 52-week high, the all-time high that we had for the S&P 500, and the COVID-19 low, right? The low that we had in March 2020. That's where I draw my Fibonacci levels to, right? That's pretty much what I do. That measures potential support and resistance levels over a long-term time span, which is what I believe you should care about as an investor. I believe you should care about that as a trader too, because you should trade around major levels. You should trade around major levels and understand the importance of that. And so keep that in mind. But also, you can measure Fibonacci retracement levels on a shorter time span, maybe a 3-month time span, maybe a month time span, to measure potential continuations or potential reversals in certain short-term trends. And we're going to look at that on a chart here in a second. Final keys. I told y'all this was going to be very simple. I told you that people try to make it more complicated than what it is. It's not that complicated. And I told you these are your final keys. An uptrend is a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. That's very fundamental. And so when you're looking at stocks, you want to measure that uptrend. You want to see what is the trend, right? What trend are we in? Are we having a series of higher highs and higher lows? That means we're bullish. That means I should be bullish. If we're in a downtrend, we're having a series of lower highs and lower lows. That means I should probably be bearish. And in order for me to establish the bullish or bearish trend, we've got to break out of that trend, right? We got to break out of that trend in order for me to have a change in sentiment from a technical perspective, if you will. Now, also, increasing volume with an uptrend / downtrend can provide conviction for a move, and decreasing volume with an uptrend / downtrend provides no conviction for a move, i.e., the market could fake you out. Okay, let me give you an example. Okay, let's say the market goes up 2% in a day. But let's say half of the normal trading volume occurred on that specific day. Half of what normally happens during that day occurred, but the market was up 2%. I am not inclined to believe that move because the normal volume that we have wasn't there. So I really don't know how the market really truly feels about what's going on. Same thing with decreasing volume, right? Like that's what I mean. Like the volume is decreasing, right? If we're going in a certain direction, but the volume is decreasing as we're going in a certain direction, that's a key for you that we may be about to reverse, right? We may be about to reverse either to the upside or the downside. So understand that the volume that we look at when we're establishing these trends are very, very important. Thirdly, larger time frames measure trends. Smaller time frames measure entries. Again, Larger time frames measures trends and smaller time frames measures entries. I can look at what a stock has been doing over the last 3 to 5 years, and that establishes what the trend is, right? What does the market feel about? What's the sentiment about this specific stock? Okay. But I still have certain points to where I can exploit how the market feels at certain times, right? And so that's what I mean. So the smaller time frames are going to measure my entries. Over a 3-year time span, I may get in and out of a stock 10 times. I may get in and out of a stock 15 times if I'm trading it, but it doesn't negate what the long trend is. You understand what I'm saying? And that's what I mean when I say that larger time frames measure trends and smaller time frames measure entries. Keep that in mind. Now, no matter what your strategy is, I don't care if you're a day trader, I don't care if you're a swing trader, I don't care what you do, I don't care if you're just a long-term investor that only buys stock. No matter what your strategy is, you have to be patient and wait on the potential move to reveal itself. If you are too overzealous, it's going to be a problem for you, right? If you're too impatient, it's going to be a problem for you. If you're thinking that every single trade that you are in is going to be your last trade, that's going to be a problem for you. Because what you got to understand is that the market is open about 251 days per year, right? So you have so many opportunities that are going to happen. If you miss your entry, let it go. If you miss your entry, please let it go. Go find another company. Go find another sector. Go find another trade, right? If you only trade a few names, stick to those few names right there and just wait. Just wait on it. I don't have to be overzealous with anything. I have all of the time in the world. You see, me personally, guys, I am a retail investor, right? I'm an individual investor. And so what that means is I don't manage money professionally, right? I don't have to provide my returns on a quarterly basis. I don't have to do that. I am only responsible for myself. That's why I say trade for yourself, right? I'm only responsible for myself, right? The profit and loss that I have, right? As a long-term investor, I don't have a timeline. I got time, y'all. I'm an engineer. I'm an engineer. That's my career. So I'm an engineer every single day. I got time, y'all. I got time to just wait and let things play out. So because I understand there's only a matter of time, like I'm building wealth every single day, share by share, trade by trade. I'm building, I'm getting experience. I'm understanding the knowledge. Like I'm not in a rush. So again, y'all, no matter what your strategy is, please be patient and wait on the potential move to reveal itself. I promise you, you are not going to regret that. I promise you, you're not going to regret that. Now, guys, that is the presentation. Okay, that's the presentation that I have. Now, like I promised you, we're going to look at a blank chart on Thinkorswim. We're going to look at a blank chart on Thinkorswim and plot support and resistance and add all of these indicators together to give you a full blueprint, right? To give you the full, toolbox that I believe that you need in order to be a very, very strong trader. I see you, AU Clayton. Preach. Patience is key to successful investing and trading. 100%. Listen to what he said, right? He said that you have to be patient, right? I'm not trying to be into a rush. I'm not trying to get into a rush. Like, I really cannot overstate that. I really let's just stop. Before I pull up the chart, let me reiterate this again. I cannot overstate the fact that you have to be patient in this game. You have to, but this is the thing, while you're being patient and while you're understanding, you have to be putting in the work. You have to be putting your reps in and be able to wait for those trades to happen. Put the practice in and do the work. That way you'll be ready to execute whenever that time comes. Again, y'all, you have to be patient and let it reveal itself. I promise you, you will not be disappointed. Now, let me go ahead. Like I said, we've got a blank chart here, y'all. We've got a blank chart, and this is a chart of the S&P 500. And we've talked about the S&P 500 all year long. right? And we've been talking about the S&P 500 all year long. That's all we've been talking about. Well, that's not really all we've been talking about, but again, the reason why we have a chart of the S&P 500 right here is because the S&P 500 is the market. When people are talking about the market, when they're having coffee or when they're at their business meetings or when they're at these retreats and whatnot, they're talking about the S&P 500, y'all. And that's why we got to pull this up. And this is ticker symbol SPY, which tracks the S&P 500. And so again, this is a daily chart. This is a daily chart over the last 1 year. And so every single one of these candlesticks, we've got our red and our green candlesticks. Every single one of these candlesticks represents a day's worth of trading. And that's very, very important for us to understand. Now, the first thing we're going to do is that we have to identify support and resistance. Okay, support and resistance. So that's what we're going to identify first. So let's go ahead and identify the top, which is up here around 479.98. And let's identify the bottom, which is right here around 348.11. So that's the first thing we're going to do. We're going to identify the top and we're going to identify the bottom. Okay, that's our major support and major resistance levels. Okay, that's our all-time high up here at the top, and then our year-to-date low down here at the bottom. Now we're going to have intermediate support and resistance levels that we see the market has been respecting. And so what I want to do is you want to read your charts from right to left. Why? Because right to left measures the most recent trading that has happened, right? And so one support level that I want to mark, and I'm going to get a little bit closer here because I want y'all to see this. Let's kind of zoom in and see what has trading been over the last 6 months. Okay, so the last 6 months. So this is evaluating what has the market been doing over the last 6 months. And so recently, we have a recent resistance level right here at 400. Okay, now we have gone above this 400 level, but this is the thing, though, we have not closed above the 400 level. That's the thing. Now you see here, right here, I believe it was Monday. It was Monday. Wait a minute. No, it was yesterday. It was yesterday. We got above 400. We touched it, remember? But this is a red candle. This is a bearish candle, right? And as we can see, the candle opened up, the body of the candle opened up above 400, but we closed below 400, right? So, and also in addition to that, we have not closed above 400 since September 12th. So it's been more than 2 months since we have closed above that 400 level. What does that mean to me? Number one, the first thing that it means to me is that this is major resistance. That's the first thing that I'm looking at whenever I see that we have not closed above 400. That's the first thing that I'm looking at. The second thing that I'm looking at is this. The second thing that I'm looking at is this, and think about this for a second, right? I've talked about how candlesticks are very, very important because they measure where the market has opened and they measure where the market has closed. Let's measure a trend line and let's see what has price action been since we hit this year-to-date low all the way up to where the market closed today. The market is up 13% in about a month, right? That is an amazing return. That is an amazing return to think about, right? And so we've had an amazing return, like I said, over that time span. But in order for me to have conviction and for me to have confirmation that the market is going to break out of the downtrend that is in, I've got to see a close above this 400 level. If I can't get a close above the 400 level, I can't get comfortable in saying that the market is going to continue to push higher. Because don't get me wrong, right? September is seen as the weakest month historically in the market. And as you can see, we had a big downtrend in September. But now we're moving into more of a good cyclical period. The market is cyclically does well seasonally during the fourth quarter, going into Thanksgiving, going into Christmas. Now, this year is going to be a little different because this is one of the worst years we've had in a long time. And so it's a little bit different. But I say all that to say, we've got to close above 400 in order for me to feel good about us continuing to move higher. I believe that the market will close above 400 over the next couple of weeks. I do believe that because I don't believe that there's anything that's going to hold the market back from closing above 400. But it has to actually close, right? It has to actually get there before I actually feel good about that. So that was a lot, but that was a lot to say 400 is a major level. Okay, what's another major level that I want to mark off? I want to mark off this 411. Okay, 411, we've got some resistance here at 411. Okay, we got some resistance here at 411. That's a resistance level. And we've also got a resistance level here at 417, right? 417, 419.96. And so this is a very, very important level for me because this is the level that we had, okay, when Jerome Powell came out during Jackson Hole and was saying that the economy is going to endure a lot of pain. Right. The economy is going to endure a lot of pain, right? Because of them continuing to raise those rates, raise those interest rates, okay, to be able to control inflation. And as we can see, this is a huge red candle. Like we sold off and we continue to sell off for the remainder of that year and the remainder of that month. You know what I'm saying? Like from that point all the way down to where we are now, we have been selling off. And so that's a major resistance level because psychologically the market was not and is not able to get above that. Okay, what's some more resistance levels that we need to look at, right? And let's look at this 430 level. This 430 level is a major resistance level, y'all. Why is that? Because we haven't closed above it in forever. We haven't closed above this 430 level since April. So that's a major resistance level. And as we can see, if you can just think about some of the chart patterns that I showed during the presentation, we've got a double top right here. A double top is a bearish pattern. That means that the market is probably going to come down. So we have a double top right here, and we had another approach of 430, but we couldn't break above it, right? We couldn't break above it. That's a major resistance level. We got some support right here around the 411 level, which I think I marked that. We got a double bottom right here around this 415. Okay. And then another level that I want to mark is right here at this 457, because this is another double top. So I'm going to mark that as a resistance level, this 457. And I'm going to mark this 461 level because we can see this level right here is right here on an island. This level is on an island. So that's another resistance level. And then I'll mark one more resistance level right here at 472, because this level even goes back to November of last year, because you see, we had a problem. We opened up at 470, couldn't close above it. We opened up at 472, couldn't close above it. So we see that's a major resistance level. And so let me back out a little bit so we can kind of see all of this. Let's see all of this. Let me get a little bit closer on the screen because I want y'all to be able to see all of this here. Bear with me here for a second. All right. So I'm going to extend all of these lines so we can see all of this very clearly here, because I want to be able to show the extension to be able to extend all of these lines. And like y'all see, it didn't take us long to identify the support and resistance lines. And so that's really what I want y'all to understand. Like the stock market, they try to make the stock market an animal that you can't tackle because they want you to think that it's too hard for you to understand. But I want you to understand that it's not that hard for you to understand. This is very, very simple, right? Does it take time to be able to identify it? Yes. But it takes time for you to be able to identify anything. Anything in life is going to take you time for, it's going to take you time to identify it. So I don't want you to sit up here and look at this as very, very intimidating. It was very, very, very simple for us to just go ahead and just identify all these levels. And so now that I've got all these levels extended, now we can really see what's going on here. Okay, like now we can really truly see. Now we can really truly see what is going on here. And so we've got our support and we got our resistance levels marked. And so that's the first thing that you want to look at when you're looking at a chart. You need to be able to establish support and be able to establish resistance. Now, let me clear this. Now, let me make another drawing set. And so another drawing set I want us to see, remember what I said before, you need to be able to identify higher highs and higher lows and lower highs and lower lows. And the way that we do that is by trend lines, right? And so I'm going to draw a trend line from our 52-week high all the way down, right? And so we've got this trend line here that we can mark, a trend line that we can follow that has showed how the market has been going. Now, if we look at this trend line, this is a bearish trend line. Why? Because we're drawing it and we're seeing that the market is continuing to go down, right? In order for me to feel good about the market at minimum, the first thing I got to feel good about in terms of the market getting back to all-time highs, we've got to break and we've got to close above and stay above this most dominant trend line in order to get back up there. If we can't get above this trend line and stay above it, I can't feel good about us getting back on a bull market, restarting the bull market. We could just be trading in a range, right? Which is great because I can make good money in a range. We can make good money trading in a range, but understand that this is a trend line. And like I said before, we're dealing with a series of lower highs and lower lows. So we've got the high, right? We've got our all-time high. We had a low, lower high, a double top right here, which is again signifying bearish, lower low, right? Lower high because we couldn't break back above this previous high, bled down, lower low, lower highs, another double top, lower low, lower highs in consolidation, lower low. Had that great run from late July to August, but we couldn't break above that 430. So lower low, like we're continuously going into this specific trend, right? And so that's what we got to pay attention to and understand. We've got to break this trend and stay above it in order for us to really truly feel good about us taking another leg higher. We've got to get above this 417, 420. We got to get above 430. These are key levels that are right along this trend line. Okay, so see, look at everything coming together right along this trend line that we got to pay attention to and we have to keep in mind. Now, so we drew our support and resistance. We drew our support and resistance. We drew our trend lines. Okay, let's add in some key technical indicators, shall we? Let's add in some key technical indicators. The first one I'm going to add is going to be the RSI. Okay, I'm going to add in the RSI. That's the first one that I am going to apply. Okay, now let me make this a little bit bigger so we can see what is going on. Now remember what the RSI is. Like just remember what the RSI is. The RSI is the relative strength indicator. Okay. The RSI is our relative strength indicator, and it measures overbought and oversold levels. And as we can see here, Look at how the RSI has been over the last year. And so here in January, we came below 30 on the RSI. We were ranging for a long time, right? Ranging for a long time. We came down close in June, didn't quite get it, but we had this overbought level right here at this 430, right here at overbought. This is an opportunity. This would have been an opportunity to play the rejection here, right? To play a rejection because of us just being overbought. Like stocks don't just move in straight lines. They're always going up and down, side to side, whatever they're doing, but stocks don't move in straight lines. And so that would have been an opportunity to play the reversal of the trend. We had oversold levels in September, which makes sense because September is historically one of our worst months in the market, right? Came down, came low, had a big low down here on October 12th, which represented that bad CPI reading. And we've been trending higher. We've sold off a little bit, which is good because when we are in a bullish trend, I like to see the market sell off a little bit. I like to see the market sell off and just to retest and just to respect what's going on, right? Like I don't want everything just running up like all crazy and we're above 70 on the RSI because it's only a matter of time before the market's going to pull back, right? So let's also add in our moving averages, right? So let's add in our moving averages here. Okay, so we're going to add in our 50-day moving average, and we're going to add in our 200-day moving average. Now, remember what I was talking about before during the presentation, the golden cross and the death cross, right? The golden cross is when the 50-day moving average crosses above the 200-day moving average. The death cross is when the 50-day moving average crosses under the 200-day moving average, which is what? Which is a bearish indicator. And so, like I said, like understand that these moving averages are delayed, like they're lagging indicators. But at the same time, I still feel like they are important, right? Because like we see that we are in a downtrend and that 200-day moving average has been running above that 50-day for a long period of time. We're talking about since March 13th, March 14th. We're talking about when we see this line cross, like we're in November. We're talking about over 8 months that we've been dealing with being underneath this 200-day moving average and things not crossing back above. And so think about this as well. Remember what I talked about earlier, right? Remember what I talked about earlier about us closing above that 400 level, right? This 200-day moving average is right around 406.38. 406.38 could be a level that we could retreat, that we could go up to and then come down from, right? I would feel good if we broke above that 200-day moving average, maybe come back down, retest it, and stay above it. That's another confirmation that we could possibly be breaking out of a trend, but we would have to stay above that 200-day moving average. I can't feel good about us continuing to move higher if we cannot break above this 200-day moving average. And the 200-day moving average is very, very important. Like I said, it is a lagging indicator, but technicians and traders are looking at it right now. And so the 200-day moving average and the 50-day moving average could be seen as technical indicators, right? They could be seen as psychological indicators that technicians and traders use to understand, okay, where is the market going to go? Because we're trading in the market real time at the end of the day. Okay, now let's add in our Fibonacci retracement levels. Okay, let's add in our Fibonacci retracement levels. And so remember what I've talked about before. Fibonacci retracement levels, I like to use them from a long-term perspective, but I also want to use them from a short-term perspective to measure pivotal points that where I can see changes in the market. And so let's go ahead and get our Fibonacci retracement levels out. And I want to draw my top. And I'm going to draw my top right here on August 26th, which represents and coincides with Jackson Hole. When Federal Reserve Chairman Jerome Powell came out, had his 8-minute speech and said that the market was going to be going through pain, right? That is the high, right? That is a key resistance level that I see that the market is going to have to break above, because that was a major event. That was a pivotal point. And we're going to draw it all the way down to our year-to-date low, right? This is the lowest that the market has been all year long. But guess what? This low coincides with us getting that horrible CPI number in October, right? That horrible CPI number in October. This is what these numbers represent, y'all. And so I want to draw from that high down to this low. And so that's what I want us to look at. Now, Fibonacci retracements, remember, what do Fibonacci retracement levels actually do? Like, what do they actually mean? They measure potential support and potential resistance levels, right? That's what they measure. They measure potential resistance levels and potential support levels, right? Also, let me ask you this question, or let's answer this question, right? Let's answer this question. Why in the world would we want to measure potential support or potential resistance levels? The reason why we would want to do that is because these potential support and potential resistance levels, right, they can tell us potential changes in a trend. Will we actually respect said trend? Will we actually get out of said trend? And so when we look at these levels, I like to look at the 78.6% fib level, 61.8, 50%, and sometimes the 38.2% fib level. Now, if we were to break below this 23.6% fib level, we're probably going to have a date with 34811, right? But as long as we stay above this 50% Fibonacci retracement level, I feel good about us continuing to move higher, right? Or at least staying in this range. I would also feel good about us moving higher to 420 if we were able to break and stay above this 78.6% fib level, which represents 462. That's very, very close to this 200-day moving average. And so when you see that, right, we're seeing, okay, we've got some levels that we can trade off of. We've got some levels that we can play off of, right? If we see a break down below this 50% Fibonacci retracement level, I don't really feel good about the market continuing to move higher. We could see a short here, depending upon what the RSI is at that time. And so these just give me potential levels that I can look at and say, okay, let's see number one, let's see what these levels are, and let's see how these levels actually line up with support and resistance that we've already marked. And that's why, measuring Fibonacci retracement levels from a short-term time span can help you when you are swing trading. Okay, now, so we've talked about everything that I pretty much want to talk about, but let's talk about the volume, right? The last thing I want to add to you, and I'm gonna let y'all get out of here. I'm gonna let y'all go. I want to talk about the volume, right? The volume of trading. Remember what I said. Increasing volume in a certain direction provides conviction and confirmation that the move is real, that the market actually wants to move in this direction. If the volume is coming down, that's telling, if the volume is coming down while the market is going up, that's telling me that algorithmic trading is present, right? Because the market isn't giving me a true direction in terms of what it wants, right? That's pretty much what I mean when I say that, right? Same thing on the other side. If the market is going down, but there's no volume there, I can't believe in that specific trend that we are dealing with in the market. However, what you can do is that you can add in volume, okay? You can add in volume, right? And if you add in the volume, okay, if you add in the volume, that can tell you, okay, certain levels and pretty much certain levels and certain break points that we can say, okay, Yeah, the market really cares about this. Like the market really, really, truly sees this. And so that's kind of what I want to look at. And so let's go ahead and add in the volume. So I'm going to add in the volume subgraph. Now, in this volume subgraph, right? How do I know when the volume actually matters? How do I know if the market cares about something? How do I know if a trend can continue, right? Like I said before, there are certain trading days and there are certain times where you look at volume and you say, man, volume is high right here. The market is trying to tell me something. Now, the first thing I want to look at, right, is I want to look at the volume that happened right here on October 13th. On October 13th, what happened was that we hit that year-to-date low. And the reason why we came down so low was because we had that horrible CPI number. Inflation was high, everybody was selling off, blah, 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 blah. At the same time, though, that 348.11 level coincides very, very closely with a 50% Fibonacci retracement level on a long-term time span. So that tells you that is a very, very key level. On top of that, the volume was 147 million shares traded. Okay, that's the second highest trading day that we've had in almost 5 months, right? That tells you that this is a very, very important level. And the market is telling you something when you see the volume that high. Also, we had another CPI reading on November 10th, last week. The volume was 141 million shares traded, third highest volume we've had in the last 2 months. CPI, the inflation, was much better than what the analysts had anticipated. So the market made a decision, and the market showed you how it felt about it because the volume was so high, right? Certain things that you see in the market that also coincide with the volume, can give you confirmation of the uptrend or the downtrend. Now, don't get me wrong. These are just certain days and certain key points that we are talking about in the market. But at the same time, these certain key points can make or break, your movement in the market. So just keep all that stuff in mind. So again, I thank you all for tapping into another episode of the Trade for Yourself podcast. Remember to please subscribe. I'm telling y'all, this is the only technical analysis class that you are ever going to need. I didn't go over that many indicators in this class. Reason being is because there's not really that many that you need. It's your job, it's your goal, if you really want to be a good technician, is to research these indicators for yourself and make a determination on what you need based on the strategy that you need. If you were paying attention to when I was adding certain indicators, to my chart, there were so many indicators that you can add on Thinkorswim. There's probably thousands of indicators you can add. I don't need to know 1,000 indicators. I only need to know a few, understand what they mean, and add them to my toolbox to utilize them based on the scenario and based on the time frame that I need them for, right? Based on what I actually need in order to be successful, right? Keep all of that stuff in mind when you are doing your technical analysis, when you are understanding these things, right? All of these tools are not the end all be all, but they can help you become a better trader and a better investor. As always, remember, don't pay for it, trade for it. I'm gonna catch y'all in the next